Accounting for amalgamation. In this lecture, we think about the concepts, types, and solve example. Myself, Dr. Naneshwar Marathi, Pratap College, Amane. Introduction. In this chapter, the first we know about the what is amalgamation. Definition. Amalgamation is the combination of two or more companies into a new entity. According to the standard accounting principles like AS14, amalgamation are categorized based on how the assets and liabilities are treated. The first type is the amalgamation in the nature of merger. The nature of merger decides on the policy of the between the two companies who decided to amalgamate. In this nature of merger, the pooling interest of method, there is a come together a same line of business. In this amalgamation nature of merger, all the assets and liabilities of the transferor companies are taken over at their existing book values. Shareholders holding at least 90% of the face value of equity in the old company become the shareholders in the new company. In this policy, both the companies, for example A company and B company working in the same business, they decided to amalgamate. In this situation, they decide the valuation of the assets. There is a provision of the depreciation, there is a provision of the appreciation in the value of assets, there is a provision of the changes in the valuation of the assets, as well as changes in the value of liabilities. In this situation, there is a result. The business continues exactly as before, just under one umbrella or one roof. Second, the amalgamation type, amalgamation in the nature of purchase. In this situation, the business is handled via the purchase method. In this situation, the business is acquired as a disguise as a union. The rule for this type of the amalgamation in the nature of purchase is one company acquires the other, and the assets or liabilities are taken often revalued to their fair market value. Result: if the price paid is higher than the net assets, the difference is recorded as goodwill. If it is lower, it is recorded as capital reserve. Purpose: achieve the economics of scale, eliminate the competition, improve the financial growth. This is a main basic objectives of the amalgamation. All these amalgamation happens under the guidelines and suggestions provided in the accounting standard AS14. Key financial terms to know. While we amalgamate both the companies working in the same business or supportive business, there is some kinds of the terms. Firstly, we regarding to know. When you are looking at an amalgamation balance sheet, you will run in this concept. The transferor company, the company that is being dissolved, that is vendor company. Suppose A and B company decided to amalgamate. In this situation, they are form a C business. In such a case, the A and B company are the transferor company, that is vendor company. Transferee company, in this situation, A and B business come together and form a C business, C limited. In such a case, this is a transferee company, the new or existing company, into which the others are handed the purchaser. Purchase consideration: the total price tag may be paid by the transfer company to the shareholders of the transferee company. In this situation, A's company shareholder, B's company shareholders now come together and they are shareholder of the C company. Why do companies do this? Why the companies come together and amalgamate? There is a some kinds of the motives. First motive is combining the resources to reduce the cost and increase the efficiency, automatically avoid the competition between two companies in such a case of the price of war, advertising expenses. Eliminating the competition, two rivals join forces instead of fighting for the some market share. Tax benefits is there, utilizing the accumulated losses of one company to offset the profits of other company. Economies of scale, larger production volumes lead to lower cost as per unit. Types of amalgamation: merger, pooling of interest, continuity of ownership, no goodwill or capital reserve. Purchase, acquisition of possible goodwill, capital reserve, not all shareholders may continue. The Companies Act 2013 and Accounting Standard 14 and Indian AS 103 govern the amalgamation in India. Choice of types of effects: accounting treatment, tax implications and shareholders' rights. Types of amalgamation. Amalgamation in the nature of merger we have already discussed, but here is the explanation and key features of the types of amalgamation of each method. The first method is amalgamation in the nature of merger is, there is explanation, when two or more companies combine to form a new entity or come together and form a new business. In this method, there is a key features: assets and liabilities recorded at book value. It depends on their terms and conditions between both the parties. Among the parties, shareholders of transferor company become the shareholders of transferor company. No goodwill or capital reserve arises. Continuity of business and shareholders. Amalgamation in the nature of purchase. In this method, the one company acquires another business and purchase consideration may differ from net assets. In this method, the nature of purchase, the purchase consideration will be decided between their agreements. The key features of this method: assets and liabilities recorded at agreed values may differ from book value. Shareholders of the transfer company may or may not become shareholders of transferring company. Goodwill or capital reserve may arise. There is a difference between the assets minus liabilities. There should be the provision for the goodwill and reserve, that is capital reserve, treated as acquisition rather than pooling. Method of purchase consideration. Normally in business there is a four kinds of the methods are considered. The first is lump sum method. In this method, there is a explanation. A fixed amount is agreed upon between the purchasing and vendor company, irrespective of net assets or payments. In this type of the example, AB Limited agrees to pay rupees 5 lakhs for company's A business as well as B business. It is decided on the basis of a lump sum method, but there is an observation of the assets and liabilities. Second, net asset method. In this method, the PC is determined based on the agreed value of assets taken over minus liabilities. In this method, all the assets are considered. Suppose, for example, suppose a company assets are given in the amount 10 lakh rupees and liabilities there is a 4 lakh rupees. The purchase consideration will be considered as 10 lakh minus 4 lakh, that is 6 lakhs rupees is the purchase consideration under the method of the net asset method. Net payment method. PC is calculated based on the actual payment made mode The shareholders of the vendor company. In this situation, the cash, shares and debentures, there is a medium of payment of purchase consideration. Suppose there is an example in the net payment method. Suppose the purchase consideration paid through the cash or shares. So to suppose the purchase consideration is rupees 5 lakh rupees, the 2 lakhs rupees in cash and remaining 3 lakhs rupees in equity shares. There is a change in also the combination, rupees 2 lakhs in cash, 2 lakhs in shares and 1 lakh rupees in debentures. 2 plus 2 plus 1 lakh, that is a 5 lakh rupees. Intrinsic value method, shares exchange method. This is also the another famous method of the given distribute and given the purchase consideration. In this method, the PC is based on the intrinsic value of the shares exchanged between the companies. Shareholders of the vendor company receive the shares of the purchasing company in a fixed ratio. For example, if a shareholders get 2 shares of AB Limited for every 3 shares held, the PC is calculated accordingly. Example of the amalgamation. While we discuss the amalgamation, we know regarding the practical method to discuss about the discuss about the concepts and conventions, we require to think about the amalgamations proper practical problem. Here is the two companies, Alpha Limited and Beta Limited. They decided to amalgamate and form a new company, that is Gamma Limited. The companies, both the companies Alpha Limited and Beta Limited, the simple balance sheet is given. There is a Alpha Limited assets, building, cash, etc. There is a 5 lakh rupees. While the Beta Limited assets, building and cash, there is a 3 lakhs rupees. This is a lump sum assets are given. There is a liabilities of the Alpha Limited, debtors, debts and creditors. There is a 1 lakh rupees of Alpha Limited. In case of Beta Limited, there is a 50,000 rupees. This is a balance sheet. Of the assets and liabilities set. When we think there is a assets minus liabilities, there is a net asset method. We easily know, because the assets minus liabilities, there is a net asset method of the payment of purchase consideration. In case of Alpha Limited, there is a 5 lakh rupees are total assets. 1 lakh rupees is liabilities. If we deduct it from 5 lakhs, there is a 4 lakh rupees is the net assets. In case of Beta Limited, there is a 3 lakhs rupees. While we deduct rupees 50,000, there is a 2 lakh 50,000. It is a net assets of Beta Limited. There is an agreement of purchase consideration and other terms and conditions. The newly formed company decide to take over all the assets and liabilities at the book value. There is no provision of depreciation, there is no provision of appreciation, there is no provision regarding the change in the liabilities amounts. So this is a simple example for the easily understood the method of practical procedure of the amalgamation. The purchase consideration is settled by issuing the equity shares in Gamma Limited at ₹10 per share. So now we think the second procedure of the amalgamation. The first step, the solution, the first step is the calculation of purchase consideration. PC is calculated on the basis of the net assets, because the Alpha Limiteds have the 5 lakh rupees share total assets minus total liabilities. There is a 1 lakh rupees, there is a 4 lakh rupees is the purchase consideration in case of Alpha Limited. For Beta Limited, there is a total assets are 3 lakhs rupees and there is a liabilities of rupees 50,000. 3 lakhs minus 50,000, there is a 2 lakh 50,000 are considered. The total PC for the Gamma Limited, 4 lakhs rupees plus 2 lakh 50,000, there is a 6 lakh 50,000. There is a PC, there will be distribute divided by 10 rupees per share of Gamma Limited. Step 2, discharge of purchase consideration. After the calculating the purchase consideration, second step is to discharge the purchase consideration. The Gamma Limited pays the shareholders of the old companies by issuing the shares. For Alpha Limited, there is a 4 lakhs rupees purchase consideration. It will be the discharge through the 10 rupees per share. So we calculate the 4 lakhs divided by 10 rupees per share. There is a 40,000 shares. In this afterwards, the Beta Limited 2,50,000 are the purchase consideration. In such a case, the purchase consideration paid through the by Gamma Limited rupees 10 per share. So we calculate through this 2,50,000 divided by 10. There is a 25,000 shares will be distributed in this method. The first method is calculate the purchase consideration. Then second is a discharge of purchase consideration. Third step is the consolidated balance sheet of Gamma Limited. In this situation, the consolidated balance sheet will be prepared. After the amalgamation, assets and liabilities of both the companies are added together. The first provision regarding the purchase consideration, all the assets and liabilities are taken at book value. So in this example, the Alpha and Beta Limited assets are 5 lakhs and 3 lakhs respectively. Here is the balance sheet of Alpha and Beta Limited. In these assets, building and cash and other assets are included. We have given the lump sum assets. In this case, 5 lakhs rupees Alpha Limited, and in case of Beta Limited, there is 3 lakhs rupees. So 5 lakhs plus 3 lakhs, there is 8 lakh. And liabilities also considered at the book value. There is a provision. All the assets and liabilities at book taken at book value or face value. In such a case, liabilities, debts and creditors are given. 1 lakh rupees in case of Alpha Limited and 50,000 in case of Beta Limited. In such a case, there is a 1,50,000. Shares are given. The purchase consideration is given through the 10 rupees per share. So 40,000 shares of Alpha Limited to shareholders. 25,000 shares will be given to the Beta Limited. So 40,000 plus 25,000, there is a 65,000. 65,000 into 10, there is a 6,50,000. 6,50,000 plus 1,50,000, there is 8 lakh rupees. And already we put the value of assets of both the companies in the balance sheet of Gamma Limited. 5 lakhs plus 3 lakh, there is a tally of balance sheet on the value of 8 lakh rupees. So when we calculate the amalgamation, we think when we start the procedure, the first we have the purchase consideration calculation, second step to discharge the purchase consideration, and third step is consolidated balance sheet of the newly formed companies. Key accounting points as per Indian standards. The pooling interest method, it is the merger, all reserves are also transferred. In this method, the purchase consideration procedure as per the Indian accounting standard ES 14103 standard, purchase method, if this is an acquisition, any difference between the price paid and the net assets will be recorded as goodwill or capital reserve. Capital reserve or goodwill may be arise when we take on over the assets and liabilities. There is, suppose assets are more than the liabilities, there is a capital reserve. If there is a liabilities are more than the assets, so there is a goodwill will be arise. In this accounting standard, there is a liquidation of the liquidation of the business. In this process, Alpha Limited and Beta Limited, uh, all their transaction will be ceased, stop after the amalgamation process started. So there is no existence of the Alpha Limited and Beta Limited. There is a newly formed company, that is Gamma Limited. But while the liquidation of the Alpha Limited and Beta Limited, we require to follow the procedure of the register of the companies, that is ROC procedure. There is a guidelines for the liquidation of the companies in case of amalgamation procedure. Key insights. While we think about the companies uh, deciding the procedure of the amalgamation, there is a firstly there is an agreement required between the two or more companies. Suppose A company limited and B company limited, Alpha or Beta Limited decide to amalgamate. They have the proper written agreement of the amalgamation. Net asset method. There is a commonly method used by the companies while the process starting the procedure of the amalgamation. Net payment method. Then in this method, there is a decided the observation of the depends on their agreements. Intrinsic value method ensures the fairness when the companies exchange the shares based on their relative worth. The company decide the share value. It may be the shares will be issued at discount, share may be issued at the at par, and shares issued at the premium. Depends on the company's agreement procedure. In this lump sum method, the while observing the both the company's assets and liabilities, the newly companies decide to purchase consideration amount. Key takeaways. In amalgamation, there is a some kinds of the key important points. The first is a merger, pooling of interest, assets and liabilities combined at book value. Purchasing the company, one company acquires the another, consideration may differ from the net assets. Purchase consideration will be decided in a written format. Uh, then realization account purpose acts as a closing account of transfer of assets and liabilities, shows how the shareholders are comprehend after the amalgamation. Expenses like realization cost reduce the shareholders entitlement. There is another key takeaways. Balance sheet of new company reflect the combined assets and liabilities of both the companies. Depends on their purchasing methods. Suppose there is a depreciation calculation, suppose there is a appreciation in the value of assets, so it will be the calculated and it will be put after the all the deductions of the asset side as well as liability side. Share capital issued equals to the purchase consideration paid. Any difference between the net assets and PC may result the goodwill or capital reserve. Shareholders, we already discussed about that. Shareholders position, A company shareholders receive the slightly less due to realization expenses. Companies B shareholders receive the full entitlement. Both sets the shareholders not hold equity in AB Limited. Practical adjustments in real cases, revaluation of assets and liabilities, treatment of reserve and surplus, recognition of the goodwill and capital reserve, accounting entries and settlements of shareholders. In short, amalgamation considered the resources, liabilities and ownership into a new entity. Realization account closed the books of old companies while the new balance sheet reflects the merged financial position. While we take the amalgamation procedure starting, all the things are considered in a written format between the two companies, and so there is no disputes will be arise. In such a case, the amalgamation will be complete. Thank you.